Drake makes $85,000 a year. His bank account has $900 in it. He has no investments, no emergency fund, and $1,000 in credit card debt he's been carrying for 2 years. He's not broke because he doesn't earn enough. He's broke because of 5 specific financial behaviors, and at least 3 of them he doesn't even know he's doing. Daniel makes about the same. He has 4 months of expenses saved, a Roth IRA getting maxed every year, and his employer match fully captured. Same income. Completely different financial lives. Here's what separates them. Mistake 1. Lifestyle inflation. This is the silent wealth killer. Every time Drake gets a raise, his spending rises to match it. The raise feels like an opportunity to finally get the thing he's been waiting for. New car, bigger place, better restaurants. Within 3 months, his new income is fully spoken for, and his savings rate is identical to what it was before the raise. This pattern has a name: the hedonic treadmill. Your life gets more expensive as your income grows. The gap between income and expenses, the only gap that builds wealth, stays the same. When Daniel gets a raise, he does one thing first. He increases his 401k contribution percentage before he adjusts his lifestyle. He gives himself a small lifestyle upgrade. But the majority of the raise goes directly to building wealth. The rule he uses: whenever his income goes up, he directs at least 50% of the increase to savings or investments before it ever hits his checking account. If you earn more but save the same percentage, you've made 0 progress. Raises only build wealth if you bank a meaningful portion of them. Mistake 2. Minimum credit card payments. The average credit card interest rate is over 20% APR in 2026. The minimum payment on most cards is roughly 1 to 2% of the balance, or a small fixed dollar amount, whichever is larger. If you carry a balance, that minimum payment strategy will keep you in debt for years and cost you a significant multiple of your original purchase. Here's the math. A $2,000 credit card balance at 22% APR with a minimum payment of around $40 per month takes over 8 years to pay off. You'd pay more than $2,000 in interest alone on a $2,000 purchase. I've been paying my card for 6 months. The balance barely went down. That's not a coincidence. That's what minimum payments are designed to do. Daniel doesn't carry a credit card balance. He uses a cashback rewards card for regular spending and pays the full statement balance every month. The interest rate is irrelevant to him because he never lets interest accrue. The card earns him money. It doesn't cost him any. If you have credit card debt right now, paying it off is the highest guaranteed return on investment available to you. A 22% APR card, paying that off is equivalent to earning 22% risk-free. No index fund can promise that. Mistake 3. No emergency fund. Most financial planners recommend keeping 3 to 6 months of living expenses in a liquid, accessible account, typically a high-yield savings account. When Drake's car broke down and cost $1,800, he had 2 choices: a high-interest credit card loan or don't get the car fixed. He charged it. The interest started immediately. When Daniel's vac went out last summer, a $2,200 repair. He paid cash from his emergency fund and refilled it over the next 4 months. The event was inconvenient. It was not financially catastrophic. The emergency fund's job is not to grow your wealth. Its job is to prevent setbacks from becoming debt spirals. A high-yield savings account pays you interest while your money sits there. 4 to 5% APY is common now. Your money should be working while it waits. Mistake 4. Ignoring the employer match. This is the only free money that most people leave on the table voluntarily. The most common employer 401k match structure is the employer matches 50% of your contributions up to 6% of your salary. If you contribute 6%, they add 3%. Your retirement account gets 9% of your salary per year, but only if you contribute at least 6% yourself. If Drake earns $85,000 and contributes 0%, his employer contributes 0. He's leaving $2,500 per year on the table, and compound interest means every dollar left on the table today is roughly $3 to $4 he won't have at retirement. Daniel contributes exactly enough to capture his full employer match before he does anything else. This is a 100% immediate return on investment before a single dollar of investment growth happens. Capturing your full employer match is not optional if you want to build wealth efficiently. It is the first move. Mistake 5. Leaving cash idle in a standard checking account. The average national savings rate at a traditional bank is near zero, often around 0.01% APY. High-yield savings accounts at online banks offer 4 to 5% APY on the same cash. If Drake keeps $8,000 in a checking account, earning 0.01% APY, he earns about 80 cents in interest per year. The same $8,000 in a high-yield savings account at 4.5% APY earns $360. That's money he's simply not collecting because it's sitting in the wrong account. Daniel has an automatic transfer set up. Every payday, a fixed amount moves from checking to his high-yield savings account before he can spend it. His checking account holds 1 month of expenses as a buffer. Everything else is either invested or in an account actually earning meaningful interest. The 5 money mistakes keeping Americans broke at every income level. 1. Lifestyle inflation. Every raise should move your savings rate before it moves your spending. 2. Minimum credit card payments. Carry no balance. If you have debt, eliminating it is your best guaranteed return. 3. No emergency fund. 3 to 6 months of expenses in a high-yield savings account. Before you invest, build this. 4. Ignoring the employer match. That's free money. Capture all of it every year before you think about anything else. 5. Cash sitting idle in a checking account. Move it to a high-yield savings account. Get paid to wait. None of these require a financial advisor. None of them require a high income. They require consistency. This video is for educational purposes only and is not personalized financial advice. If this was useful, subscribe. New videos every week. Next, the biggest money mistake of all is overpaying taxes. We'll cover 5 completely legal strategies to reduce what you owe the IRS without a tax attorney or a complicated trust. That's next.